Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing CVS's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 70 billion market cap. They're trading at $56 a share and they have 1.3 billion shares outstanding. CVS is a healthcare company. They own CVS Pharmacy, which is a retail pharmacy chain, CVS Caremark, a pharmacy benefits manager, and Aetna, a health insurance provider. Plus, they also own many other brands. They are the world's largest healthcare company. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was amazing in 2021, almost 16 billion, but it's been going down after that. Nearly cut in half, down to 8.1 billion. But most people invest in this stock for the dividend, and they pay a 5% dividend, which means they pay out 3.3 billion in dividends. So they could easily afford that payout. The problem is when the free cash flow gets low, then the stock price won't go up as much. When it was north of 10 billion, there was lots of stock price appreciation and you get a dividend. Still, 8 billion can easily cover their dividend payment, but if it keeps coming down, the stock will start to really struggle. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was 8 billion in 2021, cut in half in 2022, back up to 8 billion in 2023. A decent 7.4 billion in the trailing 12 months. Really low margins. They convert only 2% of their revenue into net income. Revenue is a sales for the company, and look how much revenue they have. It was a little under 300 billion in 2021, now it's 360 billion. They're probably top 10 in the world in terms of revenue. I know Walmart's higher, but I can't think of many other companies that have more revenue. Their revenue per share is $287. Each share is 56, so they have a really attractive price to sales ratio. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 187 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $164 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of 131. They're trading at 56, so they're trading at a 57% discount. It's a really strong buy according to the model. There are 12 companies in the same industry as CVS, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a ton in CapEx because they open lots of retail stores, 2.8 billion. United spends the most at 3.4 billion. They're a lot more leveraged than the average company, 1.1 debt to equity. The median and average is 0.7. They pay a massive dividend, almost 5%, a lot higher than anybody else. They generate lots of free cash flow, 8.1 billion, a lot more than Elevance, and Elevance has a much bigger market cap, about 70% higher. They rank 4th in market cap. These companies are a lot different. United is strictly insurance. CVS is partly insurance with Aetna, but they're really known for their retail pharmacies. So these companies are not apples to apples. But I don't pick the companies in each industry. I just see that CVS is in the industry healthcare plans, so I download every company in that industry. Because CVS is like a hybrid between a Walmart and a United, but they're much smaller than both of those companies. They have amazing price multiples. They're trading at 1x book value. That means their equity equals their market cap. Equity is assets minus liabilities. You can find that on the balance sheet. It's the value of the company according to their balance sheet. They're trading at below 10 times earnings, the best in this list. Below 9 times free cash flow, also the best in this list. And they're trading at 0.2 times revenue. The only company with more revenue is United. CVS ranks 12th in the entire world in terms of revenue. They're right here, 322 billion. United is 11th. Then a giant oil and gas company, Shell. Apple, everybody loves Apple, 400 billion. And then you see a bunch of oil and gas companies. Exxon, China Petrochemical, China National, the Dutch oil and gas company Vital, another Chinese company, Amazon nearly 600 billion, Saudi Aramco 600 billion, and the biggest revenue generating company in the world, Walmart. Also the biggest employer in the world. Vital's headquarters are in Switzerland, but they were founded in the Netherlands. That's why I said they were Dutch. Look at their revenue per worker, 323 million, only 1,500 workers. That seems almost impossible, right? Let's take a look at their 10Q. This is from 3/31/2024. It was just released. We'll start with their income statement. Just for the first quarter alone, 88 billion of revenue, up from 85 billion. Their product revenue is down. It was 58 billion, now it's 54 billion. Product revenue is when they sell products in their stores, like shaving cream, toothpaste. Aetna premiums are up a lot, 24 billion to 30 billion. Services are also up 2.4 to 3.9 billion. As a percentage, that's up a ton, the most. Investment income, that's up about 100 million. This shows us percentages. Services up 58%, investment income up 36%, premiums up 25%, and products are down 8%. Total revenue up 3.7%. That's when you compare first quarter of 2024 to first quarter of 2023. Next are their expenses. They have to buy a lot of products to put in their stores. Cost of products sold 48 billion. That's down from 52 billion. Healthcare costs 28 billion, up a lot, up 36%. And other operating expenses like the rent for their stores, 10.3 billion. Total expenses 86 billion. So operating income is down. It's down 34%. It was 3.4 billion, now it's 2.3 billion. So they're getting squeezed. Their margins are getting squeezed. Interest expense, the interest they pay in a debt, 700 million. Net income 1.1 billion, down nearly 50% from 2.1 billion. If you want to know more detail on why certain revenue went up or down, or expenses went up or down, you can look here. You can look at the next few pages. They mentioned the increase in operating expenses was mainly due to support growth in their business. Also expenses associated with Signify Health and Oak Street Health, which they acquired in March and May of 2023. The increase in these expenses was partially offset by a decline in operating expenses in the pharmacy and consumer wellness segment. If you want to learn more about their interest expense, which increased 127 million or 22%, and that's due to higher debt in the first quarter of 2024. That was driven by debt issued in February and June of 2023 to fund the acquisition of Signify and Oak Street. When a company takes on debt, it's usually to acquire other companies, especially when they take on a lot of debt. If they take on a little debt, it could just be to pay their operating expenses, pay a dividend, or refinance old debt. Their EPS, earnings per share, is down. It was $1.66, now it's 88 cents. And their shares outstanding are going down, 1.28 billion down to 1.26 billion. Dividends per share are up 61 cents to 67 cents. You always get that healthy, consistent dividend because they bring in a lot of cash. Let's take a look at their balance sheet. Current assets 67 billion, current liabilities 83 billion, so current ratio below 1. I think this is one of those companies that always has a current ratio below 1. I'm usually not too concerned if a company has a current ratio below 1 and they're really profitable. If they were not so profitable, I would be concerned. The total assets 250 billion, same as last year. Almost identical to last year, only 5 million off. They do a lot of acquisitions, 91 billion of goodwill. Here's a high-level list of some of their bigger acquisitions. They probably do dozens of acquisitions every year, but these are the bigger ones. 1969, they acquired Melville Corp. Melville was a huge retail shoe store. In 88, they acquired Heartland Drug, a big Boston area pharmacy chain. In 97, over 2,500 Revco drugstores. In 98, 207 Arbor drugstores. In 2006, 700 freestanding drugstores from Albertsons, the large supermarket chain. Minute Clinic was a big one in 2006. In 2007, they merged with CVS Caremark. In 2015, over 1,500 Target pharmacies. Aetna, a huge acquisition in 2017. Signify in 2022, and Oak Street most recently. Their liabilities are 176 billion, up from 173 billion. Their biggest liability is long-term debt, 57 billion. Assets minus liabilities equals equity, 74 billion of equity. Remember their price to book, market cap over equity, it was 1.0. Their equity is almost identical to their market cap. They're a really profitable company. Historically, their net income is 62 billion. Retained earnings is a sum of all their prior net incomes minus the sum of the dividends they paid out. They also buy back a lot of stock, 37 billion, and they raised 49 billion from selling their business, from selling stock. Let's take a look at the statement of cash flows. The first section is operating cash flow. That's gone down a lot. It was 7.4 billion in the first quarter of 2023. Now it's 5 billion. And they use the direct method to calculate operating cash flow. Most companies use the indirect method. The indirect method starts with net income. The direct method shows the cash receipts, 85 billion, cash paid for inventory, 45 billion, insurance benefits paid, 25 billion, and cash paid to suppliers and employees, almost 10 billion. That's how you come up with the 5 billion of operating cash flow. In their investing section, only 700 million of PP&E. It was 1 billion last year. Not much in acquisitions. Last year, they spent a lot. From those two big acquisitions we talked about earlier, 7 billion. In their financing section, they added 2.5 billion of debt in the form of commercial paper. Commercial paper is short-term debt. Last year, they added 6 billion of long-term debt. They bought back 3 billion of common stock. Last year, 2 billion. 840 million of dividend payments. Last year, under 800 million. This is just for the quarter. They had a cash outflow of 1.2 billion in their financing section. Let's look at a company on Simply Wall Street. Its last price, 56, 70 billion market cap. Flat in the past week, down 19% in the past year. Could be a great time to pick up the stock. Let's see what they say about the company. They provide health solutions in the United States. It operates through healthcare benefits, health services, and pharmacy and consumer wellness segments. The healthcare benefits segment offers traditional, voluntary, and consumer-directed health insurance products and related services. It serves employer groups, individuals, college students, part-time and hourly workers, health plans, healthcare providers, governmental units, government-sponsored plans, labor groups, and expatriates. The health services segment offers pharmacy benefit management solutions, including plan design and administration, specialty and mail order pharmacy, clinical, disease management, and medical spend management services. It serves employers, insurance companies, unions, government employee groups, healthcare plans, prescription drug plans, Medicaid managed care plans, CMS, plans offered on public health insurance, and other sponsors of health benefit plans. The pharmacy and consumer wellness segment sells prescription and over-the-counter drugs, consumer health and beauty products, and personal care products. This segment also distributes prescription drugs and provides related pharmacy consulting and other ancillary services to care facilities and other care settings. It operates online retail pharmacy websites, LTC pharmacies, and on-site pharmacies. LTC stands for long-term care. They also operate retail specialty pharmacy stores, compounding pharmacies and branches for infusion and nutrition services. The company was formerly known as CVS Caremark Corp. And changed its name to CVS Health in 2014. CVS Health was incorporated in 1996, headquartered in Woonsocket, Rhode Island. Here's the stock price since 1990. It was trading at $11 back then. It reached its low in 96, below $7. Then it went from 7 to 38 in 2008. That took 12 years. Then the Great Recession brought it down to 27. That was in 2009. Then it peaked in 2015 at 113. Down to the 50s from COVID, up to 100 in 2022. But down about 50% in the past 2 years. Currently trading in the mid-50s. It was just $80 in April, so it's really calmed down a ton since then. Simply Wall Street's valuation is $220. They're saying they're 75% undervalued. My model did have them a lot higher, but I tweaked it because I don't think they could get to those levels. And the goal of my model is to predict the stock price 1 year from now. Their revenue forecast for 2024 is $369 billion, 2025 $388 billion, 2026 $411 billion. It's a lot of revenue. And the free cash flow forecast for 2024 is over $9 billion, over $10 billion in 2025, and nearly $12 billion in 2026. Their revenue back in 2013 was $120 billion. And then over the next 6 years, it doubled to $255 billion. That was in 2019. And it seems to be going up every single year. That's through inflation, acquisition, and same-store growth. They had over $9 billion of debt in 2013. It peaked at $74 billion in 2019. It came down to $50 billion, but they did those 2 big acquisitions, so it's up to $64 billion. But their equity is higher than their debt. Their equity is $74 billion. They do have a good amount of cash, at least enough to service the debt. They currently have $13 billion of cash. Their dividend back in 2014 was 1.4%, up to 3.7% in 2019. Then it came down to 2% in 2022, but it's creeping back up there. The CEO's salary went from $1.2 million to $1.5 million. Her compensation is $22 million, tenure as CEO, 3.3 years. In 2015, she became the first female CEO of Aetna. And then when Aetna merged with CVS, she became the CEO of that entire company. And that's a pretty generic name, Karen Lynch, kind of like John Smith. In the past year, there's been some insider selling, some buying. One big sell by James Clark for 26,000 shares. A lot of institutional ownership, 82% of the company. The rest is by the general public, 17%. Vanguard is their biggest shareholder, then Capital Research, BlackRock, State Street, Fidelity, Dodge & Cox. Lots of big companies, UBS, Schwab, Invesco, JP Morgan, T. Rowe Price, Goldman Sachs. Hotchkiss, the California investment advisor, owns 0.5% Merrill Lynch, 0.5%. They employ a small army, 169,000 in 2013. It did get up to 295,000 in 2018. It's down to 259,000. And the ticker trades in lots of places: New York Stock Exchange, Deutsche Börse, Sitra, Mexican Bolsa, Santiago, the Bern, London Stock Exchange, Euro TLX, Wiener Börse, Lima Bolsa, Bulgaria, BAS Europe, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.